Hello, everybody, and welcome to the Sense of Security podcast. Today, we're discussing FOMO, fear of missing out, versus fundamentals in investing. James Yendry of InvestMentor is joining us today. Welcome, James. How are you?
I'm doing good. Mary, yourself?
Oh, I'm doing great. So, what is
Uh,
FOMO in investing, and why does it feel more intense today with social media, Reddit, and instant trades than in past market cycles?
so FOMO is really the feeling that everybody else is getting ahead or getting rich without you, more or less leaving you behind, and you're playing catch up in a world where everything is instantaneous and things on Instagram or TikTok, when it's more or less presenting as like a highlight reel. It's really hard to take yourself out of that situation and realize that they're not always really there. And so you start feeling like you have to keep up with the Joneses, and you really start feel further behind than where which you actually are.
So, we hear invest in fundamentals, not emotions, all the time. In simple terms, what are the fundamentals and why are they so easy to ignore when prices are ripping higher?
Fundamentals are basically the underpinnings of a business, right? So you think of how much does a company make? How fast is it growing? Is it a durable growth model? The problem with fundamentals in this FOMO and digital era is that they move slowly and prices don't. So when a stock is ripping 30% in a month and your brain just like completely decouples, like, why wasn't I just in that stock? And you completely miss the mark whenever it comes to fundamentals versus FOMO, because now you're really focused on that 30% rather than the overall structure. And it really screams louder to us because emotion is a lot. We feel it more intensely than we do logic, where fundamentals are based and grounded in logic, and FOMO is that emotion.
Yeah, it's like during COVID. Remember the whole toilet paper scare, right? Like,
Yeah.
are we gonna have enough toilet paper? And you would go to the market, no matter what, get more toilet paper. And it was like, yeah, but at the end, there was enough, right? We didn't have to worry about it.
Hurricanes were the same way in the South. Like you had everybody trying to buy up all the toilet paper everywhere you could.
It's the toilet paper. A lot of AI stocks seem to have significant gains. Nvidia crossing 3 trillion. Anything labeled AI seems to be surging in popularity. How much of this is real value creation versus investors chasing hype?
I would say the answer, it's a blend of both, right? AI is real. You have productivity gains and CapEx spending with real demand to back it. But markets don't just price in reality. They try to price in the future, and you have to figure out how much of that is priced in the future. Anything over the last few years regarding, if anybody mentions AI in an earnings call, you're seeing double digit gains, and it's not necessarily a valuation. It's more of a narrative story that these guys are spinning because they're painting the picture of the future. But you still have these individuals that are trying to chase the next level, the next thing. A few years ago, you had Bitcoin, you had automations and autonomy, and now we're going to be seeing the boom of AI and data centers, and people are really trying to capitalize on it and not be left behind in the wake.
Okay, so Nvidia does have massive revenue growth and real dominance. How do you tell the difference between a generally transformational company and a stock that's priced so perfectly that even good news isn't enough?
I would say that a great company answers a core question. Is this business changing how the world works? And I think that's a prism that a lot of great companies are trying to view themselves and position themselves here for the betterment of humanity and how we can move the needle forward. A great stock, on the other hand, is how much of that future is already priced into the stock. How much earnings can I squeeze out of it already? Things like, they take a couple of earnings calls ago. Nvidia was smashing records. They beat it, and they met all of their expectations. They did everything, yet still somehow disappointed investors, right? Their stock ends up falling, even though they mashed and beat their expectations, but because it wasn't such a large enough beat, you're starting to see good news become bad news, right? This flawless execution forever is unsustainable when you're looking at things long term. And when you start to figure out if things are priced in, maybe that growth had already been priced in, okay, with the stock will come back to what people would call some sort of an equilibrium, or where it would be justified at that point in time.
It reminds me of like when you're in school, right? High school or even middle school, and you come home and if you always get A's and your parents say, "So what'd you get on your math test?" Hey, oh, okay, that's good. Yeah, glad, keep it up. Then you have the kid who often gets B pluses or Bs and they get an A, and the parents are like, "How this is great. Oh my gosh, keep studying." And so I feel like NVIDIA is something in that scale. If you're the best student, you're like, you're doing it, you're taking the AP classes, everything is great, and then boom, you just keep getting A's. And it's okay, we'll just incrementally set it, right?
And that could also be a factor, the difference between an A plus and an A minus, right?
Right.
So if you're an A plus student and you fall down to an A minus, that even though it is seen as good inherently, it's still less than
Right.
where.
So it's interesting. All right. So we've seen some hype cycles before, .com, SPACs, cannabis. What's similar about AI and what, if anything, makes this cycle different?
I would say the similarity is the rust. Usually capital floods in quite fast. Narrative outruns numbers, and weak players ride strong stories. The difference is that AI is paying customers already with real revenues, massive balance sheets backing it. Like think of .com, right? This isn't pets.com back in the early 90s. Think of it as, if you want to take that same time frame, the early infrastructure of what would be Amazon.com. AI isn't going anywhere. The main question that you would ask is, who captures the value and at what price are they capturing it for?
Let's flip the sides and talk about Costco and Walmart, which aren't as exciting, but they've quietly crushed it. What fundamentals are actually driving their long term success?
Costco and Walmart have been winning by doing boring things extremely well. Lower prices, scale, logistics, they have generational loyalty with repeat customers. They're not trend chasing, really. They're really building on the trust generation over generation. Costco turns consumers into members. Walmart turns efficiencies into margin. And these businesses are really exciting quarter to quarter. But when you start to branch out and look at it over decades, it becomes something that you can convert into a predictable shareholder return. That's the difference.
So, Costco trades at a premium valuation for a retailer. Walmart grows slowly but predictably. How should investors think about boring stocks versus fast growers when comparing returns?
Fast growers sell the possibility. Like everybody was geared towards AI, even though it was completely unproven. Boring companies sell reliability. Costco's premium valuation reflects trust. Their whole thing is they're not charging you for it. They're predominant, like I think about 70 or 80% of their revenue comes from the subscription-based model programs that they've had. Walmart's slower growth means that it still matters because it's durable. The lesson overall isn't that boring is better, it's that consistency. Outcomes can beat exciting forecasts when exciting forecasts have yet to materialize.
It's so interesting. I saw this article recently about when people go on vacation, they're so loyal to Costco. They'll be in Japan on vacation and they'll go visit the Costco there just to see what it's like. Is that real?
It was the same thing with McDonald's. People tried different McDonald's from
Right?
all over the world. What was it? Pulp Fiction back in the day. They talked about what a Big Mac was. It was like a Royale with
Right.
cheese and France, and it actually is. It's a Royale
And
with
they had
cheese.
mustard on their fries, so weird. My
Yes,
gosh.
yes.
Okay. Okay, so psychologically, how do you stick with a steady 6% growth company when someone you know just made 50% on AI stock?
Another good question. You have to remind yourself that it's not a highlight reel. You should have exposure to both, right? You want to make sure that you have the blend so you can also participate in the upside of that 50% growth. But ensuring that the bulk of your portfolio is stable and able to weather and becomes more recessionary or hype resistant. If you have something that's over levered in tech, say 43% or more, if NVIDIA, even though they beat expectations, contracts 2%, your portfolio is taking a huge hit. Because it's not just NVIDIA that's contracting, it's going to be the entire tech sector plus the subsidiaries that rely on NVIDIA to actually push that portfolio up.
Yeah, they have just a huge market share and part of the S&P and whole 9 yards.
Yeah, envy is expensive, but discipline can be compounded.
So, people say valuation doesn't matter for growth stocks. Is there any truth to that, or is it just a story we tell ourselves when things feel unstoppable?
Valuation always matters. It's just a matter of when. Eventually, evaluation always matters, right? What people really mean is that when it doesn't matter, is it doesn't matter right now. In the short run, stories can dominate. In the long run, returns gravitate back towards earning and cash flow. Ignoring valuation for a moment, it can be fine, but you have to make sure that the valuation actually catches up with the output and the overall expectation. Yeah, until growth slows, growth is always going to slow. The three signs you're buying into a FOMO thing is, are you going to be more focused on the chart than the business? Are you buying this because it's already made money? Or you feel urgency and don't really understand what you're getting into? Conviction can feel calm, but FOMO feels rushed. And so if those three things make you feel like you're missing out or rushing you to make a decision, you don't fully know what you're actually investing into on a long-term basis, it's probably best to sit on the sidelines and evaluate it a little bit more thoroughly before you implement it into some holistic plan.
Good words of advice there, James. So, is it possible to balance both high growth, hype driven sectors like AI and boring, fundamentals driven stocks, or do investors eventually have to pick a lane?
Do they have to pick a lane? You can do both for sure. As long as you're honest about it, that becomes inherently the problem, right? Problems arise when investors pretend speculation is some sort of a long-term investing strategy, when there's nothing wrong with better growth, as long as you don't confuse it with the momentary excitement of being hype-based or driven. A question that every investor could ask themselves is, what has to be true for this stock to be a good investment? If the answer depends on perfect execution, nonstop hype, or other people buying it after you, it's not really investing. You're hoping.
So, final takeaway, if listeners remember one question to ask before buying any stock, what should it be?
One takeaway question I would say is, what has to be true for the stock to be a good investment? What has to be true? Because again, that depends on whether it's going to be hype driven. Are the fundamentals exactly where you would like them to be to guarantee the level of success that you would like to see within the portfolio? Or do other people have to lose or buy in later for you to actually materialize the gain? So that inherently is the FOMO versus the foundational approach to it.
Love it. Thank you so much, James. James with Invest Mentor, thank you so much for joining us today. We look forward to the next podcast.
Thank you, ma'am. Great seeing you again, Mary.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. IBKR Invest Mentor is a service of Interactive Academy LLC, an affiliate of IB LLC and majority owned by IBG LLC. All content provided by IBKR Invest Mentor is for informational and educational purposes only and should not be interpreted as implying any sponsorship, partnership, endorsement, recommendation, or approval by IBLLC or its affiliates. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. Investing in special purpose acquisition companies (SPACs) involves significant risks. As these companies typically have no operating history, their value depends largely on the success of future acquisitions, which may be uncertain. Investors should carefully consider potential volatility, dilution, and the management team's track record before investing.